There's the closing bell on Wall Street, and now it's market domination overtime. Jared Blicker going to be along in a moment to get us up to speed on the details from today's session. We're going to start with the major averages here, trading little change by the end of the day, particularly with the Dow. We've got it down 11 points, not even a tenth of 1%. The S&P 500 off about a fifth, between a fifth and a quarter of 1%. The NASDAQ down a third of 1%.
Stocks didn't really go anywhere from an index perspective, right?
Yeah.
And I think we were just chatting in the break. We're going to be speaking with Evercore's Julian Emanuel tomorrow on the network. He's been calling it 2 steps forward, 3 steps back, right? Or 1 step forward, 2 steps back.
Yeah.
And that's just what the market feels like right now. You think you get a little bit of momentum off that Fed meeting, and not so much, right? And it pulls back a little bit. You just can't really get a lot of things going in consecutive days.
Well, and as we've been talking about, we talked about it with Michael Kantrowitz at the top of the show, that as long as you have that uncertainty, that tariff cloud hanging over the market, it's going to be difficult to make much progress to the upside.
And who knows when that's going away.
Very good point. All right, let's send it over to Jerry now for a closer look at today's action.
Thank you. I'm trying to make sense of this too. I am noting, however, that in the midst of this, I'm going to call it a rally, 5-day rally here, we are seeing the VIX finally drop below 20, kind of hold there. And let's put the last 5 days in perspective real quickly. And you can see at the lows there over that time period. And then we'll just compare that with the S&P 500, which is doing its 7 steps forward, 5 steps back here. And we're still looking at gains of 2.5 days over the trailing week, going back to last Thursday, basically. And let's take a look at the sector action. Here we have 4 in the green. That's energy, utilities, financials, and healthcare. Nothing by much. And to the downside, tech was leading. That's down 0.7%. Right behind, we have materials and then staples, but not a lot of outsized reactions in the market here. If we take a look at the NASDAQ 100, also seeing a lot of ho-hum, although a little bit more red than green. Broadcom notably looks to be down about 2.25%. And we got some smaller names. There's Microchip down about 6% there. And let's just check in on the semi space. We'll go through some of the tech industries, and you can see NVIDIA up on the day, Taiwan Semi up 2%, but a lot of red looking in there as well. And here's the software look, more red than green. IBM is standout, down about 3.5% today. And then we'll go to small tech, and this is unprofitable tech. A lot of these ARC innovation components, Tesla in the green, but only for 17 basis points, and a bit more red than green here too. I'll leave us on the Dow, and here we can see a mixed board, and I'll just sort it by equal weight so we can see a few more losers than winners, and seems kind of par for the day. Not a lot of outsize, not a lot of outliers, but also not a lot to get excited about.
Indeed. Thanks so much, Jared. It was an up and down day on Wall Street, ultimately down. The major averages ending the day basically where they started, a little bit lower. Joining us now, Ross Mayfield, Baird Investment Strategy Analyst. Ross, it's good to see you. So looking at today, following from yesterday's sort of Fed reaction, first of all, I guess we were sort of scratching our heads even yesterday at that reaction. But why do you think there wasn't sort of much follow through?
Probably because there wasn't much to get excited about from the Fed meeting in the first place. I mean, to your point, like they didn't surprise markets to the downside. They didn't come out exceptionally hawkish. They didn't, revise inflation estimates way up or really lean on the tariff uncertainty. So I think markets were just relieved that there wasn't a downside surprise to an extent. But there wasn't a lot to get excited about in terms of their outlook. And so, that sort of relief rally, I don't think it had a lot of legs. I think if you're going to really climb your way out of this hole, you need either clarity on the tariffs, which to your all's point earlier, who knows, or you need some other sort of nice catalyst, that could come in the form of next earnings season, or maybe it's a really strong jobs report that comes out of nowhere. So, for now, we're kind of bouncing around, and that Fed meeting and Powell's presser just wasn't enough to give the market the juice it needed to really get over the hump.
Ross, I'm curious. Powell mentioned, of course, uncertainties so many times yesterday, but he specifically mentioned it when talking about the dot plot, right? And sort of they don't really know what to make of those projections right now because they don't know how the environment's going to play out. How do you look at that as an investor? What do we do with an uncertain dot plot that says consensus sees 2 cuts, but then we have 4 people saying none, 4 people saying 1? I mean, how much does it matter for a stock investor right now, what's coming out of that?
I would say not a lot. I mean, not to pile on the Fed. I think they've done a pretty good job engineering the economic environment we're in here. But the dot plot and their projections have not been super reliable, over the last 5 years. So you kind of take it with a grain of salt. You see the dissension. So it probably means that we're not getting a lot of rate cuts. But if the economy were to weaken meaningfully over the next couple of months because businesses pull back on hiring and CapEx and spending, then we could get 5 or 6 cuts if we start heading towards a recessionary environment. So they're data dependent, and they stick to that. But when the path forward is so unclear, you kind of just take it with a big grain of salt, go back to basics and focus on the drivers of either the individual equities or the sectors in the market that you own. And in this case, thinking about things like earnings and long rates rather than what the Fed is doing at the short end of the curve.
So we've had this sell-off that's gone on, and then this little bit of bounce. Have you guys been sort of buyers after we have been seeing this sell-off? How are you thinking about positioning here?
Yeah, so for me, the clear distinction to make in your mind on whether a 10% correction is viable or not is whether you think we're on the precipice of a recession. We have garden variety corrections all the time. And they're usually viable unless a recession is around the corner, in which case your average drawdown is north of 30% and lasts quite a bit longer. So we're looking for signs of recession. I don't think there's anything in the fundamentals right now that suggests recession. We had a lot of upside data surprise this week. Companies are still, they're obviously weary of the tariff debate, but they're still performing pretty strongly writ large. You see a day like today where the market does basically nothing and you've still got financial leadership. I don't think you necessarily see financials leading the way in this sort of environment if we're on the precipice of a recession. And so even if the economic growth environment isn't like boom times, it's plenty enough to fuel the market higher, driven by earnings growth, presuming we're not heading into a recession. I don't think so. So I would be a buyer on dip here.
Ross, I wanted to ask you about earnings a little bit more specifically, because we've seen estimates come down over the last month. Of course, estimates always come down for earnings, right? But I guess my question is have they come down enough at this point, or should we be expecting a lot more guidance cuts, a lot more companies talking about tariffs and sort of giving us the kinds of updates that we got from the airlines just last week?
Yeah, well, I can tell you what you'll certainly get, which is a lot more companies talking about tariffs. It is a bull market and conversations about tariffs. So we'll hear a lot about tariffs. And obviously, we've seen Q1 guidance come in a little bit soft as companies just kind of hold their breath and try to wait out this uncertainty. What you haven't really seen in a meaningful way yet is full year 25 or full year 26 revisions downward. We also haven't seen a lot of talk about some of the more growthy levers that the administration can still pull on if the tariff uncertainty gets too weighty, right? The things that investors were so excited about in December when the market ripped and bullishness was, hitting multi-year highs, whether that's deregulation, whether it's, extending these tax cuts and adding a few things to it. So there's still plenty that can outweigh the tariff uncertainty. We also can cross our fingers and hope that April 2nd brings some clarity. I'm not going to hold my breath there. I think the fundamentals are good enough to drive the market higher by the end of the year, but it's going to be a choppy ride. I don't see any way around that.
Ross, thanks. Good to see you.
Thank you.
Turning now to earnings, we got Micron, the company's second quarter numbers hitting the wire, and the third quarter forecast is above estimates. That's what's responsible for the pop in the stock here. Earnings per share coming in for the second quarter, $1.56, $1.43 is what analysts had been anticipating. Revenue at $8.05 billion, also coming in better than estimated. And the company's third quarter revenue forecast is $8.6 to $9 billion. Analysts had been looking for just under $8.6 billion. The CEO in the statement really talking about demand here, Sanjay Mehrotra, talking about extending technology leadership. They're talking about new products here. And he said, we expect record quarterly revenue in fiscal Q3. That's the forecast I just talked about, with DRAM and NAND demand growth in both data center and consumer-oriented markets. We're on track for record revenue and significantly improved profitability in fiscal 2025.
Yeah, not surprised to see the stock move higher on this news, right? Seems like a good print across the board. And one thing that sticks out with Micron, too, we've been talking so much about these different tech companies over the last month. So many companies have been struggling. Their stocks have been struggling, right? This stock was basically flat over the drawdown over the last month. So it felt like perhaps investors were feeling a little bit better about the individual picture for Micron and getting validated a bit here, but I also think maybe that's why you're seeing, a 5 or 6% jump on a very good print rather than maybe something significantly larger. Because I think as we get into earnings season and a lot of these companies have come down so much, it makes sense to see large jumps, but Micron wasn't really in that position necessarily coming into this. So good print overall.
Yeah, and to put things in perspective, Micron is a memory chip maker. There's only a handful of memory chip makers, but it is, chips in general are a commodity business. Memory chips in particular are a commoditized business. Micron's been able to break above, and some of the other memory chip makers with the introduction of more high bandwidth memory chips, more advanced memory chips that cater and fit into the AI ecosystem. So that's how they've kind of become an AI trade as well, but they still have a big commodity business. So that's just something to think about when you're looking at these companies.
Right, yeah, they have a larger, probably traditional business than they do sort of the AI part of that business.
Yeah, and that's true of a lot of tech companies that are trading on
I thought everything
AI.
was an AI trade, Julie.
It is, to different degrees. Yeah. All right, joining us now with a closer look at Micron's results, CFRA Research Senior Equity Analyst Angelo Zeno. Angelo, what do you think of these results here? It looks like it's a pretty decent beat across the board.
Yeah, so thanks for having me. Overall, yeah, you're right. It was a pretty decent beat across the board. We were looking for about a 9% sequential decline from the company, and I think it was about a 7.5 sequential decline, still implying year-over-year growth of about 38% or so. And clearly, you guys kind of alluded to the beat on the EPS side, and the guidance also kind of slightly above expectations. And we're not necessarily surprised the weakness kind of going into the quarter and why the stock actually underperformed relative to a lot of names in the second half of last year was because of some of the weakness on the consumer side of things. But the bigger story from Micron is obviously kind of the AI tilt tied to them. And you're going to see that business really kind of ramp up here throughout calendar 25 and even become a bigger piece of that business in 26 and 27. So I think, the stock as of late, at least, year to date has been performing, notably better than a number of the other semi names out there. And I think rightfully so, because you've got a really nice secular story here tied to what you guys almost kind of alluded to in terms of the memory space, a very commoditized area of the market. But as you kind of shift towards these higher value offerings out there, I think you've got a really good story, heating up here from Micron.
So, Angelo, Julie and I were just talking about this. Where do you feel like we're at with the AI story for Micron? Is it still early innings, I guess, as we like to say, right, and growing in that stage, or are we a little bit further along?
I think for Micron specifically, relative to a lot of other names out there, they were actually a little bit late to the game when it comes to high bandwidth memory and kind of getting in there. And so, we think it's still early innings for them. When you kind of look at high bandwidth memory, I think in the press release, they just alluded to the fact that they just surpassed about $1 billion in revenue. I think that's about 12% or so of their revenue, so just over 10% of their revenue. When you kind of look at the trajectory and the roadmap that Jensen Huang just provided at GTC this week in terms of Blackwell Ultra and Rubin, and then more importantly, going down to Rubin Ultra, kind of providing 3 iterations out there, moving towards high bandwidth memory 4 next year. The upside, we think, is going to be significantly higher. You're talking about billions in terms of revenue for high bandwidth this year, and even much larger going into 27 and 28. So we think early innings, at least for Micron specifically. And again, the important part here is high bandwidth memory is not commoditized yet. It's not kind of being massively produced by the Chinese out there. The ASPs are very favorable in nature, so they're going to continue to get a benefit not only on the volume on high bandwidth memory, but overall average selling prices will continue to improve.
And it's interesting, Angelo, that you brought up NVIDIA. We were having a discussion about NVIDIA earlier in the show and how it's kind of stalled out, and contrast that with Micron. Now, Micron stock has gone up a lot over the past couple of years. It's up almost 200%, but that doesn't approach what we have seen for NVIDIA. And I think investors have been trying to figure out, okay, what's the next play within AI? Does NVIDIA have the same room for upside, or should I be looking for other things like a Micron potentially that might have more room to run from here? How are you thinking about that question?
I think that's a great question. So, the way I would kind of look at this and just the overall semiconductor industry, and maybe specifically AI semis out there, is typically the best way to make money in semis is find the best content winners, right? The companies that can see the greatest content growth in businesses that are actually growing are going to be the biggest winners out there. And normally it would be a little bit, tough on the memory side of things, because typically those are markets where, again, they're more commoditized and you do see pricing pressure and what have you. But given the specific situation we're in right now, the upside potential and the kind of content growth that you're going to see just based on Jensen's kind of roadmap and what he kind of alluded to in terms of the memory growth here over the next 3 years, I think you're actually going to get more content growth coming on a name like Micron than you are in other aspects of kind of the AI trade out there. So because of that, we do like kind of the memory story out there, specifically tied to Micron. Not to mention, when you look at the valuation of this company, trading at less than 10 times next year's earnings, it's essentially kind of telling you, hey, listen, this is going to be a commoditized play forever. So even if it kind of doesn't turn out the way we think, you're not necessarily paying up for that thesis.
Angel, I wanted to go valuations with you for a second and sort of broaden this conversation out, given the drawdown that we've had across tech and across really most of the names that you cover over the last month, right? What has sort of been sticking out to you on the page over the last month that's more attractive now than it was a month ago? Where do you feel like the good opportunities are in tech broadly?
Yeah, that's another good question. So as far as kind of what we've told investors, where we feel a little bit more comfortable in, is actually on the software side of things than the hardware side of things. And a lot of that has to do with the fact that you've got the tariff concerns out there hovering over some of these semi plays as well as hardware plays out there, where you don't necessarily have that direct concern out there on the software side of things. Software valuations have actually kind of crashed significantly here, not only over the last couple of months, but over the last couple of years, as a lot of those growth rates have decelerated. But the business models are still very much intact, and you've got highly recurring businesses out there. So we do like a number of kind of these lower value oriented type names in software that typically command significantly higher valuations, whether it be, a Salesforce, even an Adobe, which has kind of really gotten hit hard. And I understand some of the pressures tied to that business. But, I think kind of you're at a point now with some of these valuations where they are definitely looking a lot interesting in nature. And then, I'd say be selective on some of these semi names out there. I do think kind of a lot of the tariff concerns out there are, kind of discounted in these names. Who knows, whether or not this leads into a recession or not. But if not, I think you've got to kind of nibble in some of these names at this point in time. When you look at a name like an NVIDIA and the visibility they have out there, or even a name like a Micron, despite the uncertainties that you have out there, the valuations look pretty enticing.
Makes sense. Angelo Zeno, we're going to have to leave it there. Appreciate it.
All right, thanks for having me.
Coming up, we'll get you the latest earnings results from FedEx and Nike. Stick around. Much more market domination overtime still to come.
FedEx fiscal third quarter earnings just crossing the stock down a quick 4% on the company's reduction to its outlook for the full fiscal year. But the third quarter numbers actually coming in okay on the revenue front, $22.2 billion, a little bit ahead of analyst estimates. Earnings per share in the third quarter, $4.51, that's 6 cents shy of estimates. But the forecast for the full year, for its full fiscal year, earnings per share $18 to $18.60. The company had seen $19 to $20 here. And an interesting note here in the statement where the company says it's unable at this time to forecast its mark-to-market retirement plans accounting adjustments for the full year. And so this forecast it's giving doesn't seem to fully account for that, although it does account for other costs related to business optimization and regulatory and legacy. It says ground legal matters. Remember, it's separating the ground business. It's in the process of doing that.
I was going through some analyst commentary coming into the print, Julian. It seemed like analysts largely expected this to not be that good of a print. Yeah. Analysts at Citi were saying that they expected FedEx to lower their full year EPS guidance. So I think that's part of what you're seeing from a stock reaction standpoint right now. Yes, shares are off 4%, but they're cutting their full year earnings guidance, and you're not seeing that large move. And the other thing, too, that we were just talking about sort of while we were in break, sometimes there's maybe something within the things that you don't see in a release that are interesting, because I would consider the general slowing consumer demand story and the slowing economy story to be part of the FedEx story. That is not attributed really in large part to what's going on here. nor is tariffs, right? Which would also be a potential headwind. So we haven't even gotten to that part of the conversation yet, which is of course going to happen on that earnings call. But it's interesting, a lot of times when there are kind of obvious macro headwinds, you will see a company point that out when they
they do make some allusion to macro headwinds, but they don't say the word consumer. John Dietrich, who is the CFO, in the statement saying our revised earnings outlook reflects continued weakness and uncertainty in the U.S. industrial economy, which is constraining demand for our business-to-business services. So they talk about that side of things, B2B, but not consumer side of the business. As you say, they're definitely going to get asked about it on the call.
Yes, there will be. That will be probably one of the bigger takeaways from the call.
Yes. Yeah. All right, let's turn to another earnings report that's getting a lot of attention here. That from Nike, third quarter earnings coming across moments ago. We got the whole team with us to break it down. Joining us, Yahoo Finance's Brad Smith and Brooke DePalma. Brooke, first, give us the numbers here.
So adjusted earnings per share beat expectations. We also saw revenue beat expectations. To take a closer look in those numbers, adjusted earnings coming in at 54 cents, revenue coming in at $11.27 billion. That was compared to what Wall Street had expected of $11.03 billion. Now that Nike brand, that key segment of the business, did also beat expectations when it comes to revenue, coming in at $10.89 billion compared to what Wall Street had expected of $10.6. Now these were pretty lowly expectations going into this report. Many analysts telling me on the phone today that Nike is getting a pass here for this quarter and two after this in the midst of what is a turnaround under new CEO Elliott Hill. Analysts and investors really looking for long-term strategic moves that Hill will make. Now, this also comes at a time when consumers are very choosy. They have to be convinced to buy with newness and innovation. We also have seen other competitors like On Holdings, Skechers, and Hoka also come into the picture during this turnaround plan at Nike.
Yeah. And Brad, you had a chance to talk to some folks at the company.
Yeah, some of the sources at Nike, and ultimately just additional context around how you're going to hear, I think, the executives continue over the next few months in this transitory period for the product portfolio, for their wholesale relationships, really try to tell the story and sell the story not just internally among folks that work at Nike, but also to some of those wholesale partners. And one of the huge things that I would be watching more for is something that we've already heard for the company, this Win Now program, where it's really 5 actions that they're trying to take to the mindset of their customers, both the wholesale partners as well as some of the customers like you and I, Josh, going into store, buying up all the most recent Jordans here on the day, but ultimately igniting their winning culture, shaping their brand for distinction, accelerating a complete product portfolio, elevating and growing marketplace, plus winning on the ground with consumers. And I know we're going to talk about one of those key areas where they do need to win on the ground regionally, but if we think about the product portfolio here, just specifically, there was a lot of talk about how they had leaned too far into dunks, how they had gone and looked at the retro Jordan brand and tried to figure out, okay, where can we make sure that we are milking that for all of the value that it potentially has? And there were some creative launches that certainly came forward, but now there's a larger question of how sustainable longer term that was, especially as analysts who you and I have spoken to as well are talking about, well, where's the newness? Where's the innovation that's really going to drive a lot more of that fanfare for the brand for the future?
And there's so much going on with Nike, right? When we think about sort of the global brand, and Brooke, I know you've sort of been tracking what's going on with Nike and their business in China. Their adjusted EBITDA coming in a little bit lower than expected in that region right now. But what's sort of the story with Nike and their China business at this point?
Yeah, analysts telling me today that despite the thinking around tariffs taking a hit on their China business, it actually has reduced their exposure to China since Trump took office back in 2016. If you take a closer look, their footwear exposure as far as manufacturing goes in China has been reduced from 29% to 18%. Apparel business also down from 26% down to 16% in the latest year. But their China business, lots of work needs to be done in order to continue to convince that consumer to buy as well. We know that we saw in this report their business sales over there. Wall Street had expected them to drop roughly 9%. They dropped roughly 15%. So that was certainly way more than Wall Street had expected.
Yeah, no, that's a great point. And one of the huge things that we have to remember about China, too, is Elliott Hill, the new CEO, who is, of course, boomerang for the company. He's had a lot of experience operating and really revving back up their China business. 2014, 2015, that was one of the main tasks that was on his desk. And ultimately, what we saw back then was a period of time where there was more globalization. It's a far different period that they're operating through now. A lot of that consumer mind share, especially localized, both US and in China, has moved towards some of the more homegrown options. And so with that in mind, it's going to come back to how they're able to sell further into that region, which products are able to move through wholesale partners, and what price too, because this is a company that also has talked about in the past wanting to make sure that much of their 65% of their inventory is selling at full price here. And so as you're working with those wholesale partners, they want to make sure that you're also not undercutting them and running massive promotions. And that's actually what we saw in the recent quarter too. They cut back on some of those promotions. Anybody who was on the platform or on the website or on the sneakers app, you probably saw sales, but less of the sales. That's what I was experiencing. I was like, where are the discounts? I need them here. I don't have as much to spend. And so that is something that we could see potentially going forward from here as well.
Meanwhile, this makes me wonder, what's the hot sneaker brand in China right now?
Well, Anta is doing really well.
Heard of Anta.
So Anta,
I've not heard that either.
So Kyrie Irving, of course, ex-Nike athlete, is working with Anta, and he's been coming out with some
China-based?
Anta, I believe China-based, but also one of the other massive things around them is they've now gotten into storefronts here in the U.S. as well.
We got to go check it out.
Googling Anta
We have Hoka, we have On, we have Adidas. What's now? We have this brand.
Correct me in real time if I'm wrong.
They look kind of cool. I don't know where they're based.
Julie's in. There we go.
Julie's buying in.
All right. Thanks, guys. Really appreciate the team coverage. That was great. Time now for What to Watch. Friday, March 21st. Starting off on the earnings front, we'll be getting some reporting from Carnival Cruise Lines and Neo. Carnival announcing results for the first quarter in the morning. It's been tough sailing for Carnival and the cruise line industry to start the year, but analysts do expect the company to report record fares in the first quarter. They'll also be listening closely for a financial update on the company's bookings for 2025.
Chinese EV maker Neo also reporting tomorrow. The company announcing fourth quarter results in the morning. Analysts expecting vehicle sales to rise, driven by its cheaper Onvo brand.
And finally, NVIDIA is wrapping up its GPU technology conference known as GTC tomorrow. A number of headlines coming from the conference this week, and CEO Jensen Huang's keynote address, of course. He announced a partnership with General Motors to build GM's future self-driving car fleet, as well as unveiled the new Blackwell Ultra and Vera Rubin AI chips.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's asking for a trend. I've got you covered for the next half hour with the latest and greatest market-moving stories, so you can get ahead of the themes affecting your money. Stay tuned.